This is chapter 13 on the statement of cash flows. Cash flow is particularly important because you need cash for anything. Pepsi, for example, notes that they create $9 to $11 billion in positive cash flows or cash inflows from operations each year. They're going to use that for a number of things, including new capital, pay back debt, repurchase company stock, paying dividends, and so forth. But cash is a critical resource of the company. The purpose of the cash flow statement is to provide details about cash receipts or cash inflows and cash payments or cash outflows over a period of time. We always classify these in terms of operating, investing, and financing activities. So the benefits of the statement of cash flows is it helps us determine the ability to generate cash flows in future periods, the ability to meet obligations and pay dividends. If you don't have cash, you won't be able to pay those. Determine the need for external financing. We need to sell more stock. We need to issue more debt. Understand the reasons for differences. So there's two indicators of performance that are critical, both the amount of net income as well as the related net cash flows from operating activities, and understand why they're a difference. And understand both the cash and the non-cash transactions for both investing and financing activities. And also the causes of changes in cash and cash equivalents between the beginning and the end of the accounting period. Now, we could put this first because what we're really trying to do, the whole statement of cash flows, is helping us determine why cash and cash equivalents change from the beginning to the end of the period. Let's start by talking about the classification of cash inflows. These are cash flows created, cash receipts, cash payments from operating activities of the company, including collections from customers for whatever we sell, interest and dividends received, and other receipts from operations. The cash outflows or cash payments are the payments to suppliers, payments to employees, payments of interest expense, payments of income taxes, and other expenditures that might be included. Next, we have investing. Investing, I like to think of in bigger long-term assets, things like property, plant, and equipment, intangibles, cash proceeds from collecting principal amounts on loans to others, sales of investments, but then on the other side, payments to acquire those long-term assets, amounts paid to borrowers, and purchase of investments. The classification of cash flows from financing activities include proceeds from long-term and short-term borrowings and cash received from owners. And cash payments are as we pay back the amounts borrowed. Payments to owners, especially cash dividends or purchase of treasury shares, which is when we're buying back shares of our own stock. So one of the confusing elements sometimes is the FASB's position on interest and dividends. The Financial Accounting Standards Board decided to require companies to present interest and dividend receipts and interest payments as operating activities. So that's interest revenue, that's interest expense, and dividend receipts. And so this reflects the reason they said that, even though financing activities would typically be interest and dividends, they reasoned that because operating activities are reflected in the income statement, it would be most appropriate to put it there, especially so we can compare income and cash flows on operating activities kind of one-to-one. However, the payment of dividends, as we pay dividends to others, first of all, it's not on the income statement, and that is the reason they sided with classifying it as financing activities. So the Financial Accounting Standards Board both require the statement of cash flows to be organized in this way with operating, investing, and financing activities. But a difference is the classification of interest received on investments and interest paid. So you're going to want to look at that and see what the difference is between the two. Now, GAAP we use within the U.S., follows FASB, but it's important to understand international standards as we work to understand other. As was mentioned earlier in earlier chapters when we discussed financial assets, the statement of cash flows defines cash as both cash and cash equivalents. And I think of those as 90 days or shorter. They can be liquidated. They mature within 90 days. And so those would be like money market funds, commercial paper, and 90-day treasury bills or shorter duration, right? Any of those would be used. So cash versus accrual, the items on the income statement and the statement of financial position represent the balances of specific general ledger accounts. However, the captions used in the statement of cash flows do not correspond to specific ledger accounts. We maintain the general ledger and the accounting on the accrual basis, not the cash basis. So that is why the statement of cash flows is explicitly considered as an important, as one of the three primary financial statements. So as we prepare the statement of cash flows, there's a direct and an indirect method. So in order to begin preparing the statement of cash flows using the direct method, we need the following information: the income statement, the comparative balances at the beginning and end of the period for the balance sheet, and additional detailed information about the changes occurring during the period in balance sheet accounts. So let's look and see. Here's the income statement. Here's the example we're going to use. We had various transactions that occurred throughout the period, and so we're going to want to look at those. We immediately say, net sales, dividend revenue, interest revenue, those are operating items, but the gain on sales of plant assets, that needs to go into investing activity. So we kind of look at that. And we see these other various. So here's the loss on sale of marketable securities. So that looks a little different. That's not an operating activity, but we're going to work through these one by one. Here is the comparative balance sheet. So we're going to look at the difference between the two. But essentially in the statement of cash flows, we're trying to determine the difference between this $20,000 and the $55,000 and why that occurred. And so we're going to have changes in balances in a number of these accounts, but we're trying to explain this $35,000 or it could be certainly $35 million, but $35,000 change. To assist in the preparation, we need additional information and the certain balance sheet accounts in terms of operating, investing, and financing activities. So here's the additional information. Accounts receivable increased by $30,000. Dividend revenue is recognized on a cash basis, but interest revenue on an accrual basis. Okay. Inventories increased by $10,000. Payables by $15,000. During the year, short-term prepaid expenses increased by $3,000 and accrued expenses payable. So these are the detailed items that we need to see the impact of cash. So let's go ahead and continue on with some of these details. We see the change in interest payable and the change in income taxes payable as well. Now, so the marketable securities account represents a debit balance of $65,000, representing the cost of securities and credit entries of $44,000. And so we can see, the difference between those two, as well as differences in the notes receivable account. So we're looking at the T account and seeing $17,000 and $12,000 in terms of debit and credit entries. And we're seeing Allison's plant asset increase by $116,000. We also know Allison's Corporation borrowed $45,000, repaid $55,000 in principal, issued bonds payable, issued 1,000 shares of $10 par stock, and cash dividends declared during the period were $40,000. So we are trying to explain the difference between the beginning of the year balance in cash and cash equivalents of $20,000 and the end of the year balance of $55,000. And so we're going to work through the steps to prepare a statement of cash flows. So let's start first with accounts receivable. If accounts receivable increase during the year, credit sales will have exceeded collections of cash from accounts receivable. So we deduct the increase in accounts receivable from net sales to determine the amount of cash received during the year. Okay, so we can see what impact that has. But if accounts receivable decrease, the collections of these accounts will have exceeded credit sales, We add the decrease in accounts receivable to net sales to determine the amount received during the year. So cash received from customers. So we have net sales plus a decrease in accounts receivable, or subtract an increase in accounts receivable. Okay, so just kind of thinking theoretically here. If there is, we'll talk here, increase in accounts receivable. So we had sales of 900, but all 900 of that was not collected. Only 870 was collected because some of it went to accounts receivable, suggesting that 870 is the amount reflected. And so as we have an increase in accounts receivable, we're going to subtract that increase. Okay, so that's the first part. Next one, dividend revenue recorded on a cash basis. Okay, since it's reported on cash basis, we're going to increase, the dividend revenue would have increased cash by $3,000. Interest revenue is recognized on accrual basis. We've already shown how to convert one type of revenue from the accrual basis to cash basis. So we're going to use the same concepts here. So we have interest received equals interest revenue. If there's an increase in interest receivable, just like accounts receivable, then we're going to add it. If there was an increase, we'll subtract it. So what we see is we compute Allison's Corporation's interest received as follows. Okay, so interest revenue, received $6,000. Add decrease in accrual interest receivable. Okay, so we're going to add this decrease. Okay, so that means less than receivable, more cash collected for the 1,000. Okay, so I have interest received $7,000. And so if we're going to put both interest and dividends in there, we're going to take this $7,000, add the $3,000. That comes from a couple slides earlier, or this slide. It says they got $3,000 on a cash basis. So interest and dividends received, $10,000. Okay, the next item, cash payments for merchandise and expenses. Okay, so we see that there, and we start to reflect that balance. So let's go to the numbers here. Cash payments is cost of goods sold, plus any increase in inventory, or subtract any decrease in inventory, and add any decrease in payables, and subtract any increase in accounts payable. So we had cost of goods sold of $500. We add the increase in inventory. Okay, so if we increase inventory, that means we spent cash on inventory. Okay, and we will also, in this case, increase in accounts payable. That suggests if there's an increase in accounts payable, it says we didn't pay cash for all of these $510,000 of net purchases. So we're going to subtract that increase. And that's kind of the way to kind of think through this. Okay, if there was cash and there was a decrease in accounts payable, it means we paid more and more. But in this case, we increased accounts payable, which means we didn't pay for all the purchases in cash yet. Okay, expenses shown on the income statement may differ from cash payments, so we need to do something with depreciation and amortization, any post-retirement benefits or amortization of bond discount. So let's see. A second type of difference arises from short-term timing differences between the recognition of expenses and the actual cash payments. Okay, that's what we've been doing. It's almost like we're undoing the accrual method, right? However, the cash payments for these expenses might occur. Maybe they occurred in an earlier period. Maybe they're in the same period. Maybe they're in a later period. So we've got to figure that out. If cash payment is made in advance, the payment creates an asset termed a prepaid expense. Okay, so if we prepaid, we paid more cash, right? And so that'd be a reduction in cash, right? Because we prepaid. If the payment is made in the same period, hey, just use exactly the expense. If it's paid in a later period, then we have an accrued expense. Remember when we talked about adjusting journal entries and prepaids and accruals and just recording those. And so here's some details of what, if you want to actually see what's here. I always like trying to think through it. So let's talk about operating expenses for $300,000, but depreciation was non-cash. So even though that was on the income statement, it was non-cash. So we're going to subtract that from expenses. That's not an expense that required cash. Okay, increase in short-term prepayments. All right, so increase in short-term prepayments suggests we have prepaids. So we paid $3,000 more. We also had a decrease in accrued liabilities, things like accounts payable. And so that was a $6,000 decrease because our liabilities went down. We must use cash to pay that. So our cash payments were $269,000. Okay, so here we have cash payments for merchandise. That's from a few slides ago. That's this $495,000. And then we have cash payments for operating expenses. There that is. And so we have cash payments to suppliers and employees of $764,000. All right. Next, cash payments for interest and taxes. Well, we paid interest expense $35,000, and there was an increase in related accrual liability of $7,000. And so that suggests cash that we did not pay. Okay, so interest paid in cash, $28,000. All right, now income tax, and with the same logic, we had income tax expense of $36,000, but our liability went down by $2,000. So that suggests we paid even more in cash to pay down both the income expense and pay down the liability here. So you can see how those look. And so now we're starting to put together our net cash flows from operating activities. All right, next let's go from operating to investing activities. So we have debit entries in these accounts represent purchases. Credit entries represent sales of the assets. Okay, however, credit entries represent the cost of the assets sold. So we see what these look like, and these include, we need to adjust for any gains or losses recorded on the sales as well. So we had purchases of marketable securities. $65,000. Okay, but later we sold a net of $40,000, and that's the $44,000, but were sold at a loss, and so that means proceeds from the sales of marketable securities was $40,000. Okay. All right. Next is notes receivable. So loans made to borrowers were $17,000, collection on loans $12,000. Okay. All right, you are a sales manager for Wigan Foods, distributor of bulk food projects to schools. The purchasing agent for Baggins Preschools tells you the company will likely have to forego its normal monthly order because of cash flow problems. Purchasing agent tells you other companies are helping it through the cash flow squeeze and asks if your company could loan the payment to Baggins. Okay, purchasing agent suggests you record the sales revenue and increase notes receivable. So the deal here is you have sold it, but you have not collected cash. And so we take a look at that, and you wonder if this is right for the company to do. Well, you want to meet your sales goals. There might be some questions of whether they will actually pay that. I personally don't feel it's unethical, but that would be something you'd think that you could do. It's a risk to loan them instead of giving them cash. You are just recording this amount. Okay. Next, Allison Corporation, cash paid to acquire plant asset. Allison Corporation purchased plant assets for $200. With $160 in cash and issuing a long-term note payable. Okay. Notice that the $160 cash payment appears in the statement of cash flows. So this was the amount in cash, right? The other is a non-cash item. You issued a note and got a building, a plant asset. So just the $160 is what's going to show up there. The next one, analysis of the plant asset accounts shows net credit entries totaling $44,000 in the year. So this is what we've sold. And so we need to reflect that. We got the $44,000, but the income statement shows these assets were sold at a gain for $31,000. Okay, so this takes off the original balance, but it looks like we actually sold it for cash proceeds of $75,000. And so that's reflected here. So here we have a summary of our net cash flows from investing activities. Cash flows from financing activities. All right, so these are those that affect the related liability and stockholders' equity accounts, typically long-term liability items. And so we're going to look at the debit and credit changes. If it's a debit change, that indicates a cash payment. If it's a credit change, it represents a cash receipt. So here we have some cash inflows and cash outflows. We're going to have, we need to present both the positive and negative cash flows. And it's asking us to report them gross instead of net. So we borrowed short-term $45,000, but we used that to pay or settle other short-term debts of $55,000. And so we have kind of the details showing there. Next one is we issued or received cash by issuing bonds payable. And so that is just the amount of cash we received. So that should be $100,000. We also sold stock for $50,000. All right. We also declared and paid dividends of $40,000. So it'd be a cash outflow. So that needs to be reflected. And so we see that detail. So the short-term borrowing, settling short-term debts, issuing bonds, issuing stock, and then paying dividends for the $100,000. So we can see that there. Okay. So now we look and see what is the relationship between the balance sheet and the statement of cash flows. So we had $35,000 and we started with $20,000, ended with $55,000, and we're working to explain that $35,000 there. So we're working to explain that. So how do companies use cash? For example, Procter & Gamble reported net income of $14.9 billion and operating cash flows of $19.8 billion. Yet its cash balance increased by only 1.4. You would have expected it would have increased by more than that, right? What explains the discrepancy? Well, P&G spent $3.5 billion in investing and $14.9 to reduce debt and purchase treasury stock. So that's how they use it. So here's the operating cash flows, and here is how it was used. All right, so back to Allison Corporation. We've gone through this and looked at the direct method. We find that the direct method is more informative and easier to understand. And while it's recommended by FASB, companies are permitted to use the indirect method. And if you were to look at most companies, they do use the indirect method. And they use that by starting with net income and making adjustments to net income to go to cash flows. Now, when you look at the difference between the two, this is only for the operating activities section. It is not for investing, doesn't affect it. That's the same either way. It is not for financing. That is the same either way. So you can see that there. Okay, so notice this is operating activities. Here's the direct method where we got cash provided by and cash used or dispersed by operating activities. So we have cash received and cash paid. Okay, but if we use the indirect method, notice we're going to get to the same 50,000 figure, but we're going to look at it kind of account by account. We're going to start net income. We're going to add back depreciation expense because that was expensed on the income statement. We also note that the sale of marketable securities and the sale on plan assets, those are investing activities. So we need to take that back out so we can classify them in investing activities. So you can kind of see similar effects and certainly the same net balance. All right, so reconciling net income with net cash flows. So in order to prepare the statement of cash flows, we need to make some certain adjustments, and we need to adjust non-cash expenses, timing differences, and non-operating gains and losses. FASB requires companies using the direct method to meet an additional reporting requirement. So they need to show a supplemental schedule showing the computation of net cash flows from operating by the indirect method. However, if a company uses the indirect method, they don't have to provide any summary schedule. So you can see that expectation. So if you were to kind of look at a grid and see what's typically done for the indirect method. We start with net income and we add back certain, and notice these are kind of current items, current assets, current liabilities. So here's the current assets here. Here's the current liabilities. And then we're going to take out any non-operating losses that don't appear in the operations section, operating activity section. And notice here is again, now the opposite, where this was the decrease. Here's the increase in these items. And then here are again our current liabilities. And that will give us net cash provided. So we can kind of look through this and work through that. Creditors and investors are particularly interested in net cash flow from operating activities. It simply says, hey, in our normal operations, are we creating cash? Can we meet our ongoing cash needs, or are we going to need additional debt or equity financing? And so the amount of cash generated by operations, is it sufficient to keep paying dividends? Or can we even increase that amount? And so these are reasons why creditors and investors are interested. There's also a method, a metric called free cash flow. Now, free cash flow is often used. One of the problems I have with free cash flow is it is often measured differently by different people, by different users, and it's simply, so here it says, while different analysts may calculate free cash flow in different ways, it is often calculated by subtracting from net cash from operating activities the cash used to purchase plant assets and pay dividends. So you could start with actually cash flows from operating activities and then just subtract the purchasing plant assets and paying dividends to stockholders. So that's a metric you could use. So this serves as a way to compare different companies, what their cash flow from operations are, what their net capital expenditures are, and what their dividends are. So you can see, starting from this, you can back into a measure of free cash flow and compare different companies to each other. Amazon, for example, at least during this period, did not pay dividends. So that's there. But these can be used to compute free cash flow. We also use cash flows to manage cash budgets. Literally, do we have the cash we need to maintain operations? We need to coordinate activities. We need to decide, do we need more resources, more assets? We're going to provide some targets and provide advanced warnings if there's potential cash shortages. For example, there might be, we might have to pay back a loan and it's going to be a big amount. Will we have enough? Will we have enough cash to meet payroll? Because maybe every 2 weeks a big chunk comes out, and do we have sufficient? And so that requires a cash budget. So what priority should managers give to increasing net cash flows? Well, creditors and investors look to a company's cash flows to protect their investment, so that's important. We want to know trends. Is it going up? Is it going down? And that will help us determine our credit rating. Are we going to go bankrupt? Well, that might, by looking at how much cash we have and cash flow, that might help us show we're a better or a lower risk to potential creditors. And so we are always managing cash flows, managers are. Okay, so sometimes we have to trade off short-term results versus long-term results. So you might be able to reduce expenditures in the short term, but that might affect a company's competitiveness in the future. And it's just like everything we do. I mean, there are costs sometimes to short-term fixes. And so we typically, we want to maximize income, maximize cash flows over the long term. But if you don't manage the short term, you may never get to the long term. And so both have to be managed. One-time boost to cash flows. Well, what can you do? You can collect receivables quicker. You can hold less inventory, but that might have an impact, but may have minimal impact. But if you reduce the size of inventory and then don't have inventory, they're available to sell when you need it, then that might affect you. Several strategies may improve cash flows, both the long-term and short-term. Deferring income taxes, changing peak pricing, making an effective product mix, making sure those products that are most profitable are that we hold enough of them. And so we may also use what we call the worksheet method. And there's both an exercise in the text as well as a lab showing the worksheet method. We won't work through that detail now, but that might be something I find it works pretty well. Once you figure out that system, you're able to complete that. We also want to note the statement of cash flows. There's also a supplementary section on non-cash investing and financing activities. So the portion that is paid, you might have bought $100,000 worth of planned asset, but part of it was financed by the issuance of long-term debt. And so that was a non-cash item. And so we need to show that as a non-cash investing and financing activity. And it might sound a little weird, but this, even though it's non-cash, it appears on the statement of cash flows.